Hey guys, that's the S&P 500, but before we get to that one, charts in the dark with you. Yes, that's right. Let's do it this way. Mood lighting. How'd you like that? Okay, so this is Tesla. So I've done a little bit on Tesla. We've actually got 5 good shorts. One of them is absolutely running. We've already spoken to you about it. It's United Health. I should actually get it up in the meantime as well. And let's use that one. UNH. Good spot from from inside the community, and a number of guys are getting good joy out of that one to the downside. We'll get that chart up in the meantime. But what I'm going to talk to you about is one that hasn't moved yet. Well, not in terms of the impulsive move we think it might make. It's a smaller time frame one. UNH might be really big. United Health, I'll come back to it. But I'm also going to include the index for you, and I'm going to do something else as well. I'm going to take a little walk past oil, and I'm going to highlight something that's interesting there as well. So it's going to be an interesting little mix for you in terms of the charting. But let's start with Tesla. So Tesla has a couple of levels of some interest that have been shown before. So if I go into draw mode with you and we discuss them, what we actually have here from Tesla is we have a 380 level that's been a tap out resistance level. I call these key levels of significance. I'm going to change, ideally actually I'd like to change it to red, but I'm going to draw in red instead. So this 380 level, it's not easily getting above that one, even in its most sunniest shining moments. You can see we've tapped out. Key levels of significance should usually just be run, at minimum touched, and usually just run. So you've got 4 tap outs there, over there. You had a close call there coming as well. There's another level, and this is where many people don't get what we do in charting. Key levels of significance often run through price behavior and aren't just support and resistance at the extremities. And a key logical round number that I would always illustrate, particularly with a stock like Tesla, is the $250 mark. Now the $250 mark, again, because I expect key levels to be run but to often be tap out points, you'll see it over here. So you'll see run and tapped out, 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 run and tapped out. And in fact, there's been some beastly sell-offs after these key levels of significance have happened. So you can see this here. I'll just minimize the pen width a little bit so I don't get too all crayony, but that's a big sell-off. That was a big sell-off. There was a second go. That was a big sell-off. Again, all the way down from there, sell-off low there. That was another sell-off that then attempted rising wedge, ... and another even further sell-off. These actually violated a third level that I'm making a little bit less fuss about, but that's down there on the 180 mark. Now, the key thrust of this is not the mega short call on Tesla, but it's a calling for weakness in equities. Generally, I'll talk about the SPX now, but because this is such a topical and also such an emotive one, I'm also going to be highlighting that the key level of 250, in my opinion, has an on balance of probabilities event downside through the 250 mark. And in fact, I would see approaching 225 as being possible. 225 for Tesla is a long way off that giddy 380 level. So let's talk about it. Why do I say it's not the absolute spiller from Manila? Well, at this junction, well, before I leave this time frame, I'll just finish putting these levels. You can see that that is a serious level. It's once, twice, 3 times, 4 times, 5 times, 6 times with sell-offs on our 250 level before breaking it with momentum, but yet still revisiting it. So you can argue that there is in fact a 7. It just didn't have any zest for staying below it for very long, and then the bulls were in charge on increasing volume for a while. Okay, so we've made the case of the 250, we've made the case of the 380 top out, but that's not playing much of a role in this discussion. So I'm going to close that. And I'm going to take you out onto a slightly smaller time frame, and we'll work our way back down. Now, the interesting thing about this, I'm including the volume, but I don't want it to interfere with the charting too much, is that this had quite a buoyant snapback out of that visitation. If I go back to draw mode, you can see there was a number there, those visitation points again to the 250 mark, and this was quite a vicious snap out of it. So it was big volume. I don't know if this is being earnings led or if this is just plunge protection with some insider forces. Who knows? It's not entirely clear for me. I don't want to get too conspiratorial here, but I'm not sure where this whole thing ends up. I want to have show dividends, show earnings. Let's show some economic events, shall we, on this chart, so that we can just see where that big, you see that volume there, that snap volume, that would have come out of a fundamental announcement of sorts. But what I do also want to go back to in the drawing mode is that was strong off there. So obviously the analysts like what they heard. I'd have to go revisit to check exactly the content of that. But what subsequently happened, a little bit smaller thickness there, is that we've had a descending kind of wedge, a falling wedge. Now, that was very high momentum up, and this has had a spill, but then there seems to have been what I call retreating buying. So it's not allowed any great plunge to plunge for too long before some support buying has provided some degree of liquidity. This has got very key close to that $250 mark, and then we've had that bounce. Okay, so strong up, falling wedge down probably suggests that this isn't necessarily going to be the spill. What do falling wedge usually do? 70%, that's not a statistical, but it's an anecdotal value, do, is that they break to the upside, or, which is what I think will occur, is you have a spill to the downside before possibly getting some upside snap back, an upside move. There is a third option, which is the minority. I include these two as a bracket, a curly bracket in that 70%. So straight up or spill through the lows of the wedge, as I've indicated with arrows, and then break up. There is a third option which can't be ruled out, and that is you've got the squeeze, yes, and these things typically occur with a falling wedge because you've got buying support and essentially the selling exhausts coming across the top, because they're doing all the chasing, and the buyers are just tactical. They think they are value buyers, and if they can buy cheaper, a little bit more, a little lower, they will. But sometimes, instead of the sellers exhausting, they could just be an advance party of more capital coming in to sell. And in fact, the tactical retreat that looks like the patient money buying on the plungers exhausts first. So you actually get a spill downside move, and then you go into a real severe spill out of a wedge. So just because it's a falling wedge doesn't mean the only way is up. There is this tendency, and the same goes for the rising wedge. You can melt up out of a rising wedge, and you can pop out and then go down, and then you can just pop down. So those are the three scenarios we typically do. So there is this option, which would be brutal, but I'm thinking that we're probably going to be a probe down and then some support and then some move up, but I don't think it's going to be exceedingly bullish. And I'll tie that in with the overall index as well. And if the overall index does what I could do, it could throw more weight on the capitulation option, which is conflicts with the direction of a traditional falling wedge. So let's have a little look at the others. Maybe I'll give you a quick run past this minor fractal that we're doing, that we're calling for the small move through the 230s, which will, of course, violate the key level of significance, that is the 250s. And it is, close it, let's do it down to 1 hour. And just rescale that a little bit for you. So what we've actually got, we've got some nasty selling gaps on Tesla. There's some real selling gaps going on here. Most of the gaps of any scale are to the downside. Yes, there's an up gap. Yes, there's an up gap, but that is ugly. That is ugly. That is ugly. and will probably be announcement based. And again, that is ugly. And this all gives potential continuation pattern with all the pressure coming across the tops here. And this is probably what will see us sell off through the 230 direction. Note also these rising wedges and grinds often broken to the downside. Okay, so clear and close. Let's take a look at the SPX and give you my take here. So overall, I'm not impressed with the valuations of equities. They're hopelessly overvalued. That doesn't mean always that they can't stay overvalued for a very long time and get further overvalued. We're very aware of that. It's a mug's game shorting American indices, particularly with the liquidity experiments that our central banker has brought down, and Trump even saying that if the Fed hadn't messed up, we could be 10,000 points higher on the various indices. I mean, have you ever? The Fed's core duty is to goose the stock market. How about that? Well, I think even they think so, and Trump certainly does. But anyway, let's not digress. Let's come back technically here. So the last high, we called for that September-October high. You may recall that on our previous YouTubes. We said this is 33 months, which is the typical standard from the first interest rate hike. And when that occurred, and it absolutely was a real pivotal moment. At that point, the Fed was still talking about we're some way away from being on neutral rates, to November saying we're not that far away after literally one increase, to eventually saying that's it, we're done. And I, of course, suspect that the next move will be to the downside on rates. And that was all happening here. So September and October here. That was that, and then we had that sell-off. And in fact, as I mentioned before, this was an HVF method head and shoulders, which is, I believe, the correct way to do a head and shoulders, and it took you out literally close to 95% of that downside move that you would have seen there. And if you traded the falling wedge entry, you would have had an exceedingly high, I'm not claiming it, but you would have had an exceedingly high risk to reward ratio. Anyway, since then, they totally went back on their monetary policy. And as a result, we got a snapback rally of some buoyancy. We can't detract from this fact that this has had some buoyancy to it. Let's get back in drawing mode. Some buoyancy to it. But now, as in before, we've got a rising wedge. And as I've already warned before, you can melt up out of that, but we are getting close to the all-time highs on that S&P. You had a few pop-outs before you got your spill there, and it was quite low vol all the way into just before that spill, and it's quite low vol here, and there's quite a squeeze. So there is real buying coming in under here. Now, will it be that strong that it's going to push you to a new high, or are we going to gasp at the what I think is a high one and make a marginally lower high before we start a downside spill? And once again, what typically can happen, and it's my favorite, it's slightly the highest probability and it's ideal as well, is that you get a little blow off candle out the top, and then you get the gap down and the spinning top and a little bit of low vol, and then you get a spill. Those are really excellent because it's the final exhaustive state. The real knockout, huffing and puffing of George Foreman, throwing all the punches, and then in a state of exhaustion before being forced to capitulate down to the canvas. Now, I want to cross-reference this to other aspect of the charts, which is our WTI, let's try to get it out there, oil. And I want to just make the most recent price action. We're quite familiar with what's gone on before, and I'm doing big time frame view here. I'm going weekly here. Again, now it seems like this is rising wedge season, but once again, if I show you this, this is your rising wedge, and you've already had, wait for it, a nice exhaustive pop out the top there. And that's exactly what I like to see. And then you've got the likes of a smallish shooting star, which is not entirely unlike that, just slightly less blow off and reversal high, but it's clearly traded up, and then it was rejected at these mid 60 levels and came most of the way down, but not the full way. It's not the smallest body, but we'll see what happens tomorrow. Now, oil could do that, having popped out the wedge, churn, and then do the spill. So this is very popular and a good way, because it's good to see that final exhaustion. I'll draw it again on the thinner pen view so that it's less obscured. That gives you nice final, oh, we're dominant, we've been winning, all that buying, all that buying, all that buying. And then the next candle warns of counter push. A counter push that is coming. So you've got it on the S&P, you've got it on oil, and this is not a strong economy. People, I'm seeing downside earnings reports. I'm also seeing another indicator, that is all the big private companies rushing to do an IPO. This is them unloading their high-valued IPO listing price stock onto the retail investor mug via institutions and directly to retail markets. I wouldn't say I'm the most connected person in the world. I'm being offered IPO stock on lots of things. Lyft, on Uber, which is coming soon. Remember, that's the Google guys. Remember, Facebook got out, tried to be 100 billion and got out very near a relative top and then crashed 70% odd. They want to get out and have an idea. They want to chase a big ass number and sell it to you. Yes, subsequently it became a FANG and has gone up and surpassed its list price. But at that point in time, relative highs are often signaled by the IPO market. So bear that in mind. You have a lot of companies that are close, private, close to wanting to listing and wanting to get the timing right. They want to get the most capital for offloading their equity. In other words, the owners cash out on an IPO. It's kind of like a sale. That's how you have to view it. They still retain control and a controlling stake, but they get in a whole bunch of liquid cash, which counts for a lot in a market that's about a downturn. So oil, looking exhaustive on a rising wedge. SPX very close to the previous high where it got spanked. Still low vol, but previously it got very low vol and did that tiny little double top M for you before really going over for the spill and smashed previous resistance with gusto before putting in a big leg down. And this time, the banks, the central banks that is, haven't got much more to offer. They've already committed to no more rate rises. They're going to have to start talking about QE and rate cuts to keep goosing the stock market. That's not to say they won't, but they'll probably have need some more justifiable cause, and that could be a sell-off in the once again, the markets. We have 4 other amazing shorts like UNH. I'm not sure I went past that in the end for you. We actually, the guys called it before their earnings warning, which came out, which is once again the forensic value of a good trading system. It gives you heads up on something that should be shorted before the news catches up with you. Have a look at this. I'm going to take the volume off here just for this point because it's interrupting slightly on the chart. Go away, you. In fact, I'll leave it. It's going to be a bigger headache to get the keyboard out from there. But you can see it's come all the way from $20 if you get enough history way back when. So this particular company, you could have had it at $15 in 09 and it's traded almost $290 up top here. That's a heck of a run. $15 to 300. You know what that is. That's 20x that it's done since 09 in 10 years. 20x in 10 years. Wow. I think we're seeing sight of a first of our setups in a new trend, and I think big sell-offs can come, not just to our targets, which were at the $200 levels, but well sub. Especially if SPX comes to the party and starts a major down leg to somewhere here as a relative low before basing out, before they pump it again. That could be a real steam releasing moment on UNH. Well done to Horim and the guys in the community that were identifying this setup, and once again it's got very much similar type structure to what we like to see. Squeeze across the top, proper slap in the face here as we call it, bam bam bam, at close to its highs. First setup in a new trend. Initially a big move up, but then again real harshness on the sell-offs, and then a rising wedge to set up that spill. That gets you in really nicely for a high. That's your risk. That's your entry and a really high reward, and we've still got more downside we're expecting to see out of that. And I would actually close over a performance expected, so we'd only do a partial close on target. So that's what you miss by not being in the community. There's 4 other shorts that we are trading and discussing to the short side. One similar with huge big time frame sell-off capability. So we're going to be looking, I'm looking for a weak for oil, the S&P 500, US equities generally, certainly further potential downside. There might be a little bit of a relief rally on this one because it's already sold off a lot. I would, if it came back to these levels at the 236 to 240, I'd actually short again. And with those weakness, I'm also expecting Tesla, which is the one I'm leading with because it's such a controversial stroke, greatly discussed, to trade below its 250 levels, to run 230, in fact, which will take it out of its top floor, that 2 blue lines, into the bottom floor, which is the 250 to the 180 range down here, and out of this 380 giddy heights, where this is our 250 mark. So watch out for that downside for Tesla, but it may not be the big one, but it could just be if it's supported by the SPX and we get a wedge spill, which is the minority outcome, but you know what might come next. Probably my money bet, a run past the 230s and then some basing out and some weak rallying, depending what the S&P is also doing. It could turn into a bigger rout. Okay, with that, I'm going to close and finish up. That's your update on oil with the Market Sniper. By the way, I've also need to do a precious metals. I'm afraid gold is not a buy right now. Don't get me wrong. I love gold. I hate fiat currency. I want my money in gold. Gold is not looking undervalued. It's undervalued in terms of all precious metals being undervalued to fiat, in my view. But in terms of the market-based valuations, I expect it to sell off in the new week on fear. I expect gold to sell off. Platinum is undervalued compared to gold. It could be the chosen buy for accumulating on the downsides and on sell-offs, but it's not the time to put all your cash in gold. Build it up and buy the dips that will potentially be coming. Okay, love you and leave you. I hope that's useful and enjoyable, and we'll speak again in the new week. If you want to be part of our community where you can really get these updates on an ongoing basis, you need to go to themarketsniper.com and book a chat. Talk to one of our representatives, someone just like you who 2 years ago started trading with me and now is one of our educators in the Top Gun HVF, someone who made the decision to go ahead. You can find out from his own words how it worked, and he can give you an update on the options as well. Till then, catch you later.